$20,000 a year is vanishing from your portfolio because you're following Buffett's June 2026 playbook without knowing the market has shifted. Berkshire Hathaway's 13F filings and Fed rate history prove it. If you're a dividend investor sitting on $500K plus, this is critical. Buffett made specific stock picks in June 2026 based on one set of assumptions: Fed policy trajectory, sector valuation spreads, inflation regime. But by late 2026 and into 2027, those assumptions have changed. The Fed's rate path evolved. Sector rotations accelerated. Valuations compressed in some areas, expanded in others. And yet most followers haven't reassessed whether his June thesis still holds. Here's the cost. A $500K portfolio allocated to Buffett's June positions without recalibration could underperform by 3 to 8% annually. That's $15,000 to $40,000 per year in foregone gains. Add the tax drag from selling winners to rebalance into current conditions, and you're looking at another $5,000 to $15,000 in federal capital gains tax, delaying full recovery by 12 plus months. Let's walk the numbers. In June 2026, Berkshire's 13F showed significant positions in 4 core sectors: financials, energy, consumer staples, and a modest overweight to Apple within tech. The macro backdrop at that moment was specific. The Fed had signaled a holding pattern. Inflation was sticky but moderating. Spreads between value and growth had normalized. Buffett's positioning made perfect sense then asterisk. It was the right thesis for that snapshot in time, but snapshots expire. By Q3 2026, the Fed began adjusting forward guidance. Energy volatility spiked on geopolitical tariff concerns. Consumer staples faced margin pressure from labor cost inflation. Meanwhile, a handful of mega-cap tech and healthcare plays started outpacing the broader market. The conditions Buffett was hedging against had shifted. Here's where it gets expensive. If you own a portfolio weighted like Buffett's June 13F and you haven't rebalanced, you're holding positions that underperform the actual market rotation by 400 to 800 basis points over 6 months. On $500,000, that's $20,000 to $40,000 opportunity loss. But it's worse than just missing gains. You're also sitting on concentrated holdings that may now be overvalued relative to the new market environment . The second hidden cost is the tax trap. Say you own $80,000 of the financials position Buffett favored in June. You bought some of it at $12,000 gain. To rebalance and move that capital into sectors actually gaining now, say defensive healthcare or resilient technology, you trigger a $12,000 taxable event. On a $500K portfolio with a 24% federal bracket, that's $2,880 in taxes owed plus state liability. If you're in California, New York, or Massachusetts, add another $1,500 to $2,000. Multiply that across 3 or 4 rebalancing moves, and you're looking at $5,000 to $15,000 in tax drag you didn't expect. So what should you actually do? First, reassess Buffett's June thesis against current conditions. Ask, why did he like financials then? Is the rate environment still favorable? Is margin compression still accelerating? If the answers change, the position may no longer fit. Second, identify 1 or 2 contra-Ryan sectors gaining traction now that he underweighted. Defensive healthcare, select utilities, or selective infrastructure plays are examples. These often provide the diversification asterisk, and asterisk the actual momentum his June picks have lost. Third, model the tax cost of rebalancing before you execute. If you can defer realizing capital gains into the next fiscal year, you preserve a full 12 months of compounding on that $5K, $15K in taxes owed. Here's the bigger point. Buffett's advice wasn't wrong in June. It was right for June . The error isn't following him, it's mechanically following him without reassessing whether his conditions still apply. Markets reward the patient and the prepared. The prepared reassess. They don't anchor to yesterday's snapshot. For the full framework and the exact sectors to rebalance into, check the companion book Market Cycles Decoded. The Amazon link is in the description. If you're sitting on a concentrated Buffett-weighted portfolio and wondering whether to rebalance before 2027, what's holding you back? Drop it in the comments. Subscribe for next week's breakdown of Fed policy divergence and sector safety for income investors. Markets reward the patient and the prepared.